On February 1st, 2025, the United States announced 25% tariffs on most Canadian goods entering the U.S. and 10% on Canadian energy. Canada retaliated. The trade war was on, and most Canadians had no idea what that actually meant for their wallet. Here's what it meant. Grocery prices in Canada are now over 30% higher than they were in 2019. The average Canadian family of four is expected to spend $17,571.79 on food in 2026, up by nearly $1,000 from the previous year. Food inflation in Canada reached 7.3% in January 2026, more than 3 times the Bank of Canada's 2% target. Canadians paid 20.3% more for coffee in 2025. Fresh or frozen beef prices rose 13.5%. Oranges rose 10.4%. The Canadian dollar has been assumed to average 72 cents US over the projection horizon, meaning every imported good you buy costs more in Canadian dollars before tariffs even touch it. Payroll employment in industries dependent on U.S. demand was down 1.9% in Q2 2025 compared to the same quarter in 2024. In Windsor-Sarnia, the unemployment rate rose to 10.0% in Q3 2025, up 1.7 percentage points year over year. This is not a political video. This is a personal finance video. Because whether you support or oppose what's happening between Canada and the U.S., the tariffs are real, the price increases are real, and the impact on your household budget is real. The question is, what do you do about it? By the end of this video, you'll have a 5-move financial defense plan built specifically for this economic environment, using the Canadian accounts, the investment tools, and the spending strategies that protect your wealth when the cost of everything keeps rising. Most Canadians know there are tariffs. Most don't know the full timeline. And understanding it is critical to understanding why prices are still rising 15 months after it all started. Here is what actually happened, month by month. February 1st, 2025. President Trump announced sweeping tariffs on Canadian goods, 25% on most imports, and 10% on Canadian energy products. March 2025. Canada retaliated with counter-tariffs on $30 billion worth of U.S. goods, escalating to $155 billion after 3 weeks. The tariffs covered a broad range of goods: grocery products, appliances, electronics, furniture, household items. Q1 2025. Canadian businesses rushed to ship as much as possible to the U.S. before tariffs took full effect. Canada's goods exports rose 10% in the first quarter. GDP growth hit 2.2%, but this was borrowed from the future. April 2nd, 2025. The U.S. announced sweeping new global tariffs. Liberation Day. Canadian goods exports to the U.S. dropped more than 15% in April alone. April 3rd, 2025. Within 48 hours of Liberation Day, appliance prices at Canadian retailers rose 7% compared to the control group. Within a month, they peaked at 10% higher. September 1st, 2025. Canada lifted most counter-tariffs. Prices fell back. But for groceries and appliances, the reversal was only nearly complete within 3 months. Some prices never came back down. Early 2026, the Supreme Court of the United States struck down several of Trump's sweeping emergency tariffs under IEEPA, providing some relief, but the core tariffs on steel, aluminum, automobiles, and key Canadian exports remain. The result, 1 year later, Canada's merchandise exports to non-U.S. economies were up 17% year over year in the 12 months to January 2026, while falling 10% to the U.S. Canada is diversifying, but the damage is ongoing. The key takeaway from this timeline: prices went up fast and came down slow. The Bank of Canada's own research confirmed this. Tariff pass-through to consumers was rapid, but the reversal was incomplete. You paid more, you kept paying more, and the tariff uncertainty isn't over. GDP growth in Ontario and Quebec is expected to be at the bottom of all Canadian provinces in 2026. These are Canada's two most populous and economically important provinces, and they are bearing the heaviest cost. Your action step: understand which industries and regions are most exposed. If your job is in manufacturing, steel, aluminum, automotive, or lumber. The second half of this video contains specific financial protection steps for you. Let's stop talking about tariffs in the abstract and put a real dollar figure on what they're costing the average Canadian household in 2026. The grocery bill, food inflation in Canada, reached 7.3% in January 2026, significantly higher than overall CPI of 2.3%. Grocery prices are now over 30% higher than they were in 2019. The average family of four will spend $17,571.79 on food in 2026, up nearly $1,000 from 2025. Broken down by specific items in 2025, according to Statistics Canada. Coffee, up 20.3%. Fresh or frozen beef, up 13.5%. Meat overall, up 5.8%. Oranges, up 10.4%. Groceries overall, up 3.5% in 2025, accelerating to 4.8% to 7.3% in early 2026. For lower-income households, the squeeze is particularly severe. Families in the lowest income quintile spend approximately 27% of their disposable income on food and non-alcoholic beverages. The Canadian dollar. The Canadian dollar has averaged approximately 72 cents US, meaning every product imported from anywhere in the world costs 28% more in Canadian dollars before any tariff is even applied. A weaker loonie doesn't just affect U.S. imports, it affects everything imported from anywhere: electronics, clothing, appliances, vehicles, because global trade is largely priced in U.S. dollars. The job market. Jobs in industries dependent on U.S. demand paid an average of $37.08 per hour in 2024, 5.9% more than other industries. Payroll employment in those industries fell 1.9% in Q2 2025 year over year. These are among the best-paying jobs in Canada's goods-producing sector, and they are disappearing. In many cases, laid-off manufacturing workers are only finding replacement work in lower-paying service or gig economy jobs, creating an underemployment problem where people are still working but not at their full potential or desired hours. The combined household impact. When you add the grocery bill increase, $1,000 per year, the higher cost of all imported goods from a weak loonie, and the wage pressure in exposed industries, the total household financial impact of the trade war is measurable in thousands of dollars per year for the average Canadian family. The average family of four now spends $17,571.79 on food alone in 2026. That is money that cannot go to a TFSA, cannot go to an RRSP, cannot compound, cannot build wealth. Your action step: calculate your own household food bill increase. If your family of four is spending $1,000 more on groceries in 2026 than in 2025, that's $83 per month that used to be available for savings and investment. Segment 5 shows you exactly how to reclaim it. Here's the piece of the tariff story most personal finance channels aren't talking about, and it directly affects every Canadian investor. The equity market impact. The S&P/TSX Composite Index, Canada's main stock index, is heavily weighted toward energy, financials, and materials. These are exactly the sectors most exposed to U.S. tariffs and trade disruption. When tariff uncertainty spiked in spring 2025, consumer confidence plunged, even as household spending held up temporarily. Business investment softened significantly across Canada in 2025 as companies facing tariff-related uncertainty became hesitant to commit to capital expenditure. Softened business investment today means slower corporate earnings growth tomorrow, which affects the long-term return trajectory of Canadian equity holdings. Why this actually argues for more investing, not less. Here's the counterintuitive truth that every major market downturn confirms. Despite the trade war, net foreign direct investment in Canada was positive for the first time in more than a decade in 2025. Global capital still flowed into Canada, because long-term investors understand that tariff disruptions are temporary, and asset prices during uncertainty represent opportunity, not danger. The S&P 500, which tracks the 500 largest U.S. companies, most of which are globally diversified and not purely dependent on U.S.-Canada trade, has continued its long-run trajectory. A low-cost S&P 500 ETF held inside a Canadian TFSA is not materially exposed to Canada-US tariff risk in the way that individual Canadian manufacturing stocks are. The TFSA advantage in an inflationary environment. While prices for consumer goods were directly or indirectly affected by tariffs, including new cars, clothing, footwear, household appliances, grocery items, and travel services, the overall CPI slowed to 1.8% in February 2026. In a tariff-driven inflationary environment, holding cash loses real value every year. A TFSA invested in an S&P 500 ETF averaging 8% annually grows at 4 times the rate of 2% inflation, protecting purchasing power where cash cannot. The Canadian dollar hedge. When the Canadian dollar weakens, as it has against the US dollar through the trade war, Canadian investors holding US-denominated assets in their TFSA or RRSP benefit from a currency tailwind. A 10% decline in the CAD/USD exchange rate adds approximately 10% to the Canadian dollar return on a US equity ETF, even if the underlying asset price is unchanged. This is not speculation. It is the mathematical reality of holding globally diversified assets in a country whose currency weakens during economic stress. Your action step. Review your current TFSA holdings. If they are exclusively in Canadian equities or GICs, you have concentrated exposure to the exact sector most affected by tariffs. Adding a globally diversified S&P 500 ETF is both a performance decision and a tariff risk hedge. One of the most visible responses to the trade war has been the Buy Canadian movement, and it deserves an honest financial analysis, not just a patriotic one. Canadians returning from the U.S. shrank 25% year-over-year in 2025, with increased travel within Canada and to non-U.S. destinations. Provincial governments exercised product boycotts around American-made liquor, and federal and provincial governments now have Buy Canada procurement policies. Here's what that means financially. Where buying Canadian genuinely helps your wallet. Domestically produced food, Canadian beef, Canadian dairy, Canadian produce in season, is not subject to the same tariff-driven price pressures as imported goods. In a show of national patriotism, Many Canadians pledged to keep their dollars at home by purchasing domestically grown and produced products. Retailers assisted by highlighting Canadian goods through special maple leaf and Canadian flag labels. Buying Canadian food in season is a genuine cost-saving strategy in 2026. Canadian produce in summer and fall, strawberries, corn, tomatoes, squash, is cheaper and unaffected by U.S. tariffs or a weak Canadian dollar. This is not just patriotism, it is financially rational. Where buying Canadian is more complicated, manufacturing is deeply integrated across the Canada-U.S. border. Many products labeled Made in Canada contain U.S. components. Canadian companies that rely on cross-border supply chains face logistical and financial challenges even when their final product is Canadian. The supply chain reality means buying Canadian for manufactured goods is more nuanced than it appears on a label. The financial strategy. The Honest Buy Canadian recommendation for 2026 is this: shift your grocery spending toward Canadian-produced seasonal food where possible. It is genuinely cheaper and genuinely protects against tariff exposure. For manufactured goods, services, and investments, the analysis is more complex and should be driven by price and value, not geography alone. Chicken prices are set to rise substantially in 2026 as customer demand increased due to higher beef costs. Canada has strengthened beef import partnerships with Mexico and Australia, which should help stabilize prices, but the squeeze is expected to continue until at least 2027. This is not a short-term disruption. The food price pressure is structural and will persist for at least another year. Your action step: audit your grocery spending. Shift high tariff-exposed categories, U.S.-sourced beef, citrus, coffee, toward Canadian alternatives or in-season domestic produce where available. This is one of the few consumer decisions that simultaneously saves money and reduces tariff exposure. Here it is: the 5-move financial defense plan built specifically for this trade war economic environment. Using the registered accounts the Canadian government created, the investment strategies that hedge tariff and currency risk, and the spending decisions that keep more money in your pocket. Move 1. Maximize your TFSA with globally diversified assets. The TFSA 2026 annual contribution limit is $7,000. Canadians eligible since 2009 have up to $109,000 in cumulative room. In a tariff-disrupted economy, the TFSA is your most powerful wealth protection tool. Because its tax-free growth means inflation, and tariffs cannot erode its value the way they erode cash. Hold a low-cost S&P 500 ETF or globally diversified ETF like XEQT or VEQT. These funds are not dependent on Canada-US trade. They own pieces of the world's largest companies across multiple countries, providing natural protection against Canadian-specific economic disruptions. Move 2. Build or top up your emergency fund at 4% plus. Tariffs have caused weaker overall job growth and increased underemployment risk, particularly in manufacturing, agriculture, and energy. In this environment, a fully funded emergency fund is not optional. It is financial armor. Hold 3 to 6 months of expenses in a high-interest TFSA savings account at EQ Bank or Wealth Simple Cash, currently earning 3.5% to 4.5%. Your emergency fund earns real passive income while remaining fully liquid. If your job is in a tariff-exposed industry, steel, auto, lumber, manufacturing, consider extending this to 9 months. Move 3. Use the RRSP to reduce your tax bill in a slower economy. Canadian GDP growth in 2026 and 2027 is projected to average around 1.4%, significantly below trend. In a slower economy, salary growth is constrained. Every dollar you can recover through RRSP tax deductions becomes more valuable when raises are smaller and less certain. The 2026 RRSP limit is $32,490. At a $70,000 Ontario salary, a $5,000 RRSP contribution generates approximately $1,650 back as a tax refund. Reinvest that refund directly into your TFSA. It compounds tax-free, while your RRSP deduction reduces this year's tax bill. Move 4. Audit and cut tariff-exposed recurring costs. Many recurring household costs have quietly embedded tariff exposure that most Canadians haven't reviewed in over a year. Coffee, up 20.3% in 2025. Switching from a daily $6 cafe coffee to home-brewed Canadian roasted coffee saves approximately $1,200 to $1,500 per year. Beef, up 13.5%. Shifting one beef meal per week to chicken, eggs, or Canadian legumes saves approximately $400 to $600 per year for a family of 4. U.S. streaming subscriptions billed in U.S. dollars. At 72 cents on the dollar, a $15 per month subscription costs 20 Canadian dollars and 83 cents. Review and cut any that aren't actively used. U.S. cross-border shopping. With the 72-cent loonie, any deal in U.S. dollars needs to be 28% cheaper just to break even on exchange alone before any tariff. Move 5. Invest the savings back into your TFSA immediately. This is the move that separates the people who financially survive this environment from those who build wealth through it. Every dollar saved by shifting grocery spending, cutting tariff-exposed subscriptions, or recovering RRSP refunds, automate it directly to your TFSA on the same day it arrives. Do not let it sit in a checking account where it will be spent. The $1,000 per year your family saves by shifting grocery habits, invested in an S&P 500 ETF inside your TFSA at 8% annual return, becomes 10 years, $15,645. 20 years, $49,423. 30 years, $122,346. Tax-free from a grocery spending shift alone. Your action step. Set up all 5 moves this week. The emergency fund and TFSA automation take 2 hours. The grocery audit takes 1 evening. The RRSP contribution can be made before the March 2nd, 2026 deadline. Check your available room in CRA My Account today. Here's the part of the tariff story nobody is telling Canadians. And it's the most important part for anyone trying to build wealth in 2026. Economic disruption creates opportunity for the prepared. Canada posted its first per capita GDP increase in 3 years in 2025, despite everything. Net foreign direct investment was positive for the first time in over a decade. Canada's merchandise exports to non-U.S. economies were up 17% year over year. Diversification is happening. The trade war is forcing Canada to do something it should have done decades ago: diversify away from its near-total dependence on the U.S. market. That diversification, painful as it is in the short term, creates a more resilient Canadian economy in the long term. For investors, here is the historical truth about market disruptions. Every major economic shock in the last 100 years, the Great Depression, the 1970s oil crisis, the 2000 dot-com crash, the 2008 financial crisis, the 2020 pandemic, has been followed by a recovery. In every case, the investors who stayed in the market and kept buying through the disruption ended up dramatically ahead of those who sold and waited for calm. Consumer confidence plunged in spring 2025, but household spending held up. The Canadian consumer is more resilient than the headlines suggest, and Canadian businesses are adapting. When you invest in an S&P 500 ETF or a globally diversified ETF today, at prices shaped in part by tariff uncertainty and economic anxiety, you are buying assets at a discount to what they will be worth when the uncertainty resolves. That is not speculation. That is the historical pattern of every economic disruption in modern history. The Canadians who will look back at 2025 and 2026 as a wealth-building turning point are the ones who kept contributing to their TFSA every single month, did not panic sell their equity ETFs when markets dipped, used the slower economy to reduce high-interest debt, redirected tariff-driven cost savings back into investments, built an emergency fund deep enough to never be forced to sell at the wrong time. The tariff environment is painful. It is also temporary. The compounding math inside your TFSA is permanent. Your action step: if you have not contributed to your TFSA this month, do it today. Economic disruption is the environment where long-term wealth is built by the disciplined and eroded by the reactive. Let's come back to where we started. Groceries are 30% more expensive than 2019. The average family of four will spend $17,571.79 on food in 2026. The Canadian dollar sits at approximately 72 cents US. The best-paying Canadian manufacturing jobs are disappearing at minus 1.9% year over year. These are real numbers. They are happening right now, and they will continue to happen for at least another year. Because Dalhousie University's food price report projects the food affordability squeeze will continue until at least 2027. But here's what's also true. The 5 moves in this video, collectively, can turn a portion of the tariff cost back into long-term wealth. The family that shifts $1,000 in annual grocery spending to Canadian seasonal alternatives and invests that $1,000 into their TFSA every year for 30 years at 8% builds $122,346 tax-free from that single shift alone. The person who cuts 3 unused USD billed subscriptions, stops their daily $6 cafe coffee, contributes to their RRSP before the March deadline, and maxes their TFSA with a globally diversified ETF. They are not victims of the trade war. They are using the trade war as a forcing function to build better financial habits than they had before it started. Canada posted its first per capita GDP increase in 3 years in 2025 despite everything. The Canadian economy is more resilient than the headlines suggest, and the Canadians who kept building wealth through this disruption will look back at this period the same way every generation of disciplined investors looks back at their version of it, as the moment the foundation was laid. The tariffs are making you poorer. The 5 moves fight back.